You're listening to the Financial Source Podcast, your daily dose of sentiment updates in the European and U.S. sessions and critical risk event previews so you stay up to date with what's moving the market right now. Each session is carefully crafted personally by the Financial Source analysts and voiced by our AI hosts who, as it turns out, sound a lot better than we do. Here's Rachel and Michael with this session's deep dive.
Welcome to the Deep Dive, where we try and strip away some of the market jargon and get to what's really driving things globally. This week, if you're listening to any market chatter at all, everyone's got their eyes glued to one thing.
Yeah, it's pretty hard to miss, isn't it?
Friday's U.S. non-farm payrolls. It feels like the market's, make or break moment. But here's what's interesting and maybe a bit surprising. It's not just that big headline number. It might actually be the sort of subtle revisions to prior months that could really steer things. We're going to unpack why that seemingly small detail is, well, maybe the real key.
Exactly. It's not just counting jobs, is it? It's the critical piece that gives us a hint about what the Federal Reserve is really thinking. And what's fascinating is how this one snapshot, this U.S. labor market picture, doesn't just affect U.S. rates or the dollar.
Right.
The ripple effect is huge. It can shift policy debates over in Brussels. It can influence how much people are spending in London, even move gold prices in Zurich.
It's all connected, often in ways that aren't immediately obvious.
And for this deep dive, we've sifted through, the sharpest mark briefings, the best analysis out there. We've tried to filter the noise. The idea is to give you a direct line into what's genuinely driving sentiment right now. Think of it as your shortcut to being properly informed.
That's right. By the time we wrap up, you should have a really clear picture of this intricate dance between the economic data, the central bank moves, and how the markets react. You'll walk away not just knowing the facts, but hopefully with the context to connect the dots yourself. A really well-informed view on why Friday's numbers are such a big deal.
Okay, let's get into it then. The U.S. non-farm payrolls report, we know it's always important, but this time, wow, it feels like the market has put everything on this one number. Is there maybe a risk there? Are we sort of over-indexing on this single data point? Or is there something genuinely unique about this moment that makes it the ultimate decider for the Fed? That's a great question. And I think you're right to ask it. The context really is everything right now. We've seen U.S. inflation be, a bit of a mixed bag, hasn't it? Uneven. Some bits cooling, others still quite sticky. But overall growth, surprisingly firm, pretty resilient, actually. What really shifted the mood, though, was that last payrolls report.
The previous one.
Exactly. We got a softer headline number, and this is crucial. Those significant downward revisions to the months before that.
Okay.
That combination kind of whispered to the market, maybe the Fed needs to think about cutting rates perhaps sooner than we thought. So this Friday's report isn't just another data point. It's almost like a confirmation hearing for the Fed's next big decision.
Confirmation hearing, I like that.
Yeah. If it leans weak, market confidence in rate cuts gets stronger. If it surprises on the upside, that whole narrative gets questioned again.
Okay, so if the market's treating it like that, like a confirmation hearing, what are people actually expecting for this Friday? What's the consensus view?
Well, the general agreement among analysts points towards a sub 100,000 payrolls number. So fewer than 100K new jobs. That'd be a noticeable slowdown.
Right.
We're also looking for maybe a small tick up in the unemployment rate and maybe wages cooling off a bit around the edges. That's important for inflation, obviously. But as you hinted at earlier, and this is really the insight to grasp, the revisions to the prior months could matter just as much, maybe even more, than the new headline number itself for shaping those rate cut expectations.
Right.
A big downward revision to last month, for example, could have a huge impact. Even if Friday's headline is just okay, it tells you more about the underlying trend.
I can see that. Those revisions really could change the whole picture. It's like finding out last month's result wasn't quite what it seemed at first glance. But let me play devil's advocate for a second. What if the headline number is strong, but the revisions are still soft? How does the market juggle those conflicting signals? Or does the Fed just focus on one?
Yeah, that's the million-dollar question, isn't it? And it really highlights how nuanced these reports are.
Yeah.
Look, the market will react instantly to the headline. That's the first thing the algorithms see.
Sure.
But then, very quickly, analysts, traders, they'll dive into those revisions if they conflict. You could see some real choppiness, some volatility, as different interpretations battle it out. The Fed, though, tends to look at the broader picture. They focus on the trend.
Okay.
So a consistently softer trend, even if you got an occasional strong headline number, will likely keep them leaning towards easing policy. They want to avoid, yanking policy back and forth. Right now, if you look at market pricing, it's already suggesting a pretty high chance of a 25 basis point cut in September. But the pass after that, how many more cuts, how fast they come, that really hinges on how this labor data unfolds. It feels like the Fed's waiting for this signal to confirm their strategy for the next year or so.
That really clarifies the Fed's position, doesn't it? But now, thinking about how complex this jobs report actually is, I'm wondering about the immediate market fallout. How does this one number, perhaps more than any other this week, actually translate into moves in something like the dollar or gold? This is where it gets really interesting, I think.
Oh, absolutely. The U.S. dollar, it gets pretty dramatic around these numbers. It's currently kind of hovering near some important support levels on the charts, almost like it's holding its breath.
Yeah.
And this report is basically its moment of truth. Will it confirm that Fed's going easy vibe, or will it throw a spanner in the works and send the dollar moving sharply? If we get a weaker than expected number, especially if it comes with those downward revisions we talked about,
Right.
that would typically push U.S. Treasury yields down. And lower yields make dollar assets less attractive compared to others. So that tends to weaken the greenback. It strengthens the case for faster Fed cuts.
Okay, so weaker jobs, lower yields, weaker dollar. Makes sense. What about the flip side?
The flip side is a firmer report. Let's say a surprisingly strong headline, maybe even upward revisions.
Okay.
That would likely make the markets think, hang on, maybe the Fed won't cut as much or as soon as we thought. That pushes U.S. yields up, and suddenly the dollar looks more appealing again. It could definitely see a bounce. It's really that sensitive.
And gold, often seen as the classic safe haven, but it also really reacts to interest rates and the dollar, doesn't it? How does the payrolls data feed into gold's next move?
That's exactly right. Gold is incredibly keyed into this same policy question. We saw bullion's recent climb still out around that $3,400 level. That's a key resistance point, proving quite tough to break. Its next big move will almost certainly be dictated by where these payroll numbers send yields and the dollar. Think of gold as, well, it doesn't pay any interest.
Right, no yield.
So its appeal goes up when real interest rates fall. If we get that weaker labor data pushing down yields and weakening the dollar, that creates space for gold to try again, maybe push beyond those recent highs. Holding non-yielding gold just becomes more attractive then.
And if the report is strong?
If it's firmer, pushing yields and the dollar up, that makes other interest-bearing assets look better, and it tends to weigh on gold, pushing it back down towards nearby support levels.
It's so clear the U.S. payrolls report is like the North Star for the Fed right now. But what about the rest of the world? This single U.S. number, its impact doesn't just stop at the U.S. border, does it? How are other central banks thinking? Europe, the U.K., Canada? How are they factoring this into their own decisions? Are they waiting, reacting?
You've nailed one of the most fascinating parts of all this, the global interconnectedness.
Yeah.
Let's take the euro area. We're expecting their inflation data, the flash HICP, to stay near 2% for the headline. The supercore reading, which strips out even more volatile stuff, maybe around 2.2%, so that mostly fits their story of gradual disinflation. But what's really interesting for the European Central Bank, the ECB, is the currency channel. That's sharply in focus.
Meaning the euro's exchange rate.
Exactly. If the euro strengthens quite a bit because the Fed looks set to cut rates while the ECB maybe holds off longer, that difference in policy paths could really influence what the ECB says and does. A stronger euro makes imports cheaper. That brings in what they call imported disinflation.
Ah, right. Cheaper goods from outside help lower their inflation.
Precisely. And that could give the ECB more breathing room, maybe even nudge them towards easing policy themselves sooner than they otherwise might.
Interesting. So the Fed's move influences the euro, which influences ECB policy. What about the UK? Are we getting any clues on how consumers are doing there?
We are, actually. In the UK, we get retail sales figures just before the U.S. payrolls. That gives a really timely snapshot of consumer spending. And that's crucial because the Bank of England is also kind of edging towards easier policy. They'll be watching very closely to see if consumers are pulling back, especially with high borrowing costs still biting.
So weak UK sales could add pressure on the Bank of England.
It could definitely bolster the case for them to cut rates, especially if the U.S. data also points towards a Fed easing cycle starting soon.
And Canada. Our neighbor to the north, how are they playing this?
Canada's situation is quite unique because their own labor data comes out at the exact same time as the U.S. report on Friday.
Oh, wow. Same day, same time.
Yep. And that's not just a coincidence. The Bank of Canada has explicitly said it's monitoring these spillovers from U.S. policy when figuring out its own room to maneuver on interest rates. So, if the U.S. report is soft, suggesting more Fed cuts are coming, that could actually give the Bank of Canada more confidence to ease its own policy without worrying too much about the Canadian dollar weakening against the U.S. dollar, its biggest trading partner.
So their path is really tied closely to the Fed's. That simultaneous release makes it even more intense.
It really does.
Okay, so payrolls is clearly the main event, but it's not happening in a vacuum, is it? What about those background issues, things like trade policy, tariffs, geopolitical tensions? Even if they're not the headline this Friday, how might they kind of subtly influence how the market reacts to the jobs data? Maybe make the reaction bigger or smaller?
That's an excellent point. They're always there, aren't they? Trade and tariffs, for example. They're definitely a meaningful input, even if it's indirect. Think about it. A weak U.S. payrolls number might normally push the dollar down. But if there's an active trade dispute going on, say with China, that currency move could be amplified or maybe even muted, depending on how companies are adjusting their supply chains or managing inventories in response to those trade policies. We already mentioned Canada watching U.S. policy spillovers and Europe watching the euro for that imported disinflation effect. Those are both partly trade-related channels. They're always humming away in the background.
So trade policy adds another layer of complexity.
Absolutely. And then there's geopolitics. Now, the immediate calendar might look a bit quieter in terms of brand new market-shattering headlines right around Friday, but the ongoing backdrop into security concerns in Europe, the situation in the Middle East, nuclear diplomacy talks, that stuff is always a potential source of volatility.
It's latent risk.
Latent risk. Okay. What that means for Friday, if something suddenly flares up, even if it's totally unrelated to jobs, you could see investors suddenly dash for safe havens, like gold, or maybe even the dollar itself, ironically. That could potentially override, or at least really muddy the waters of, the immediate reaction to the payrolls number. It just reminds us the world keeps turning, even when we're focused on one data point.
That's a really crucial reminder. So before we get to the main event on Friday, are there any previews, any secondary checks that traders use to try and get a feel for which way the wind might be blowing, kind of like opening acts before the headliner?
Precisely. Yeah, there are a couple of things traders watch. They'll look at the employment components within the ISM surveys.
The purchasing manager surveys?
Right. Those give a good forward-looking pulse on hiring in both manufacturing and services. They'll also keep a close eye on the ADP report.
Which is the private payrolls estimate.
Exactly. It comes out before the official government numbers. Now, neither of these will completely overshadow the main payrolls report, of course.
No.
But they provide useful secondary cross-checks. They can definitely influence positioning in the run-up to Friday, maybe give traders a bit of a hint. It's like checking the weather forecast before the big outdoor event, Helps you prepare.
Wow, what a week this is shaping up to be. It really drives home just how connected everything is in the global financial system. So let's just pull this all together. This deep dive, it's really shown us how that U.S. payrolls report is the absolute pivot point for global markets this week. It doesn't just guide the Fed's next move, it affects the dollar's trading range, it influences gold's potential breakout, and it even has knock-on effects for inflation and spending in other major economies.
Yeah.
It's pretty incredible how much weight this one report carries, especially when you factor in those often overlooked revisions.
It is fascinating, isn't it? This intense focus on what seems like a single domestic data point really just underscores how profoundly interconnected the whole global financial system is. Every number, every policy tweak, every geopolitical tremor somewhere sends ripples everywhere, influencing things far away. It really makes you wonder, how much of the future can we actually predict just by watching a few key indicators like this? And what unexpected links, what connections might we be missing when we get so hyper-focused on just one release? It's a complex picture, and Friday just happens to be when we tug on one of the most important threads.
That's a powerful thought, isn't it? Well, hopefully now you're armed with the context insights from this deep dive. You've got a better map, let's say, to navigate the market terrain this week. We definitely encourage you to keep exploring, keep asking those questions. Thanks so much for joining us for this crucial market update.
Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.